Right here on NDTV Profit. Now, a conversation up next is with somebody who's had about 50 plus strategy meetings in the month of July with clients and funds across Mumbai, Chennai, Hong Kong and Singapore. And I think the takeaways from some of these could be very important from an investing framework setup perspective. Gautam Duggad, who's done all of these meetings, head of research at Motilal Oswal Institutional Equities, with us on the show. Gautam, good having you. Thanks for taking the time out. I hope all is well. Now, before we get into the nitty-gritties, Gautam, simple सवाल ये है, meetings के बाद mood bearish है कि bullish है?
Hi Neeraj, good afternoon. Thanks for having me. I wish I had the black and white answer to that question because the kind of market that we are in, it has left everyone perplexed. Last 12 months you've gone everywhere and ended up nowhere. We are at the same Nifty level today, virtually where we were 1 year back, despite all that has happened in this world. Geopolitics, tariffs, war, all sort of things have happened. The moot point is that the market broadly respects corporate earnings. It's very much evident. Last 12 months, your earnings growth was very tepid. You hardly got a flattish earnings. Markets have also been very flat. Of course, there have been stock-specific, sector-specific, returns which people would have met. But at an index level, we've done nothing. Right? As we move forward, there is a hope that earnings will recover a little bit given the steps that the government and RBI has taken. And therefore, the markets will find new legs to run on once we are into the second half. That's the usual hope that we always have when earnings don't come, that first half nahi aaya, second half will come and festive season will bring some cheer and then earnings will recover and hopefully the markets will pick up. But yeah, the mood is very, very balanced. There's neither too much bearishness because liquidity is not allowing the market to fall. For 6 months, you got $43 billion of domestic money. Last year, CY24 was 63. So between 18 months, you got almost $105 billion of domestic capital. Against that, foreigners have sold close to $8 to $9 billion. And you've seen a lot of supply also through QIP, blocks, IPOs. So market has treaded water, not gone anywhere, and it's waiting for earnings to pick up.
So Gautam, here's the question, right? With all that has happened, the capex push, everything else that has happened on the fiscal side too and the monetary side, right? What's the case for a 5% earnings growth? Why should earnings growth be only 5% considering that it's not that FY25 was a gangbuster year, right? It was a very, very ordinary year. Why should the market only grow 5%?
So no, our expectation...
earnings, sorry.
Yeah, absolutely. Our expectation on earnings is 10 to 11% for Nifty for FY26. In the first half of earnings season, that is till yesterday, we already cut the forward earnings by 1.5%. So we are down to 9.5%, 10% earnings growth for FY26. If we see the things picking up in the second half, hopefully there will not be any more cuts. But Neeraj, please understand sector by sector. You have two big sectors, banks plus IT, which contributes anywhere between 45 to 50% of the Nifty profit pool. And they are not doing much, especially large cap IT has literally thrown in the towel at 4-5% earnings growth. Banks, because they've had a phenomenal last 6-7 years. I never tire of pointing out that in FY18, the total banking profit pool or financials profit pool for our coverage universe was 49,000 crores, which in FY25 became 4,93,000 crores. Now, on that base, with best of the asset quality behind and incremental credit cost not helping much, and your credit growth still trending in 10-11%, and at the margin, you have rate cuts. So clearly, the pressure on NIMs, the pressure on PPOP growth, very much evident there. First half, in fact, we're expecting banking earnings to be down, right? So two big sectors not helping the cause. Then you have consumer staples, where you've seen some of the results which have already come in Asian Paint, Nestle, Colgate. Earnings have declined for all three, right? So clearly 3-4 big sectors are not firing. That's the case for this quarter. And our expectation for FY26 is also that the big sectors will find it very difficult to grow. You can add auto in that, right? Even though auto, we've turned more bullish versus where we were 3 months back. But the fact of the matter is whatever 10-11% growth that we are penciling in, it is coming from small sectors like cement, capital goods, a little bit of consumer durables, EMS, pharma. But the big sectors are not doing much. The likes of banks, IT, consumer, auto, they are not firing. And commodity, where the expectations are very high, you never have visibility there beyond next 3 months, because the underlying commodity prices play a huge role in deciding the commodity earnings. So the construct of the index is such that while you would scoff at 10% earnings growth number two, but that's the kind of reality that we are right now living in, with sector specific nuances and context deciding the trajectory of index earnings.
Mr. Duggad, hi, Mahima this side. While I was going through your note, you've said that both value and growth investors are going to find it tough. So my question to you is that generally, when one goes and picks a stock, there are certain traditional qualitative and quantitative attributes that one looks at. That is your return on capital, pricing power, management quality, etc. But considering that it's going to be tough for both of these kind of investors, when you're saying that one needs to be very specific when it comes to picking up stock, what would you focus on when it comes to your term as stock picker in this market?
So Mahima, look, we all have been used to this term, stock pickers market, bottoms up market, the very cliched terms. But the reality of the market is this market has become a stock pickers market because the growth is very modest, right? And the dispersion of earnings growth within the sector and across the sector is very high. I mean, if you chosen a right sector but a wrong stock in that sector, you've not made money. I mean, IT being a very clear case in point for last 3 years. If you are positive on IT but we are concentrated on large cap IT, you made nothing. Infy, TCS, they've done nothing last 3-4 years on a compounded basis. But if you had positions in Coforge, Persistent, Hexaware, all of those stocks, you outperform significantly. That's the case for consumer too. If you are in consumer staples and not in consumer discretionary, your portfolio would have underperformed. So sector after sector, you're finding those divergences, both in stock price returns as well as the earnings growth, right? So what do we do? What did we do in our model portfolio a couple of weeks back? We've increased the allocation of mid and small caps in our model portfolio. In April, we had 76% allocation to large cap. Today, we have brought it down to 69%. And again, when you talk about mid caps, it's very misleading to talk about aggregates or index. Mid caps are generally bottoms up and very company specific factors. So, if I were to tell you that we are expecting 19% earnings growth today for our mid cap coverage universe of 100 stocks in an environment where nominal GDP is going to grow at 9%, it is very difficult to marry the two arguments. But then in mid caps, you have very specific company specific nuances and factors which are at play. So what we've done in every sector barring banks, we've increased our allocation to mid caps. So we've removed Hindustan Lever. First time we have zero consumer staples weight. We've reduced weight on Reliance. We've removed Trent. We've removed Tata Steel. We've removed ABB, right? We've doubled weight on Suzlon. We've added Radico Khaitan, Jubilant Foodworks. Some of these niche names across categories, like we've added Jindal Stainless in place of Tata Steel. So the approach is to focus on mid and small caps, so the earnings growth is going to be slightly better. And therefore, despite expensive valuations of mid and small cap indices, if the growth differential is 2x between large and mid cap, which is what we expect this year to be, large cap at 8 to 10% growth and mid cap at 20, then this valuation premium could sustain. That's the hope. And of course, we are also banking on the fact that the domestic money keeps pouring in. Of course, that's not a very, you don't make an investment case basis liquidity. But yes, if the liquidity is bountiful, it obviously helps the matter when you're talking about mid and small caps. That's been the case for last 2-3 years. So combination of earnings growth, growth visibility, and every sector you have to go stock by stock. And then you obviously hope that those earnings don't get downgraded. That's the approach we followed in our model portfolio construction this time. Net, we have increased the component of mid and small cap in our model portfolio by 700 basis points versus where we were in April 2025.
Okay, Mr. Duggad, thank you so much. That's very insightful. And it's interesting when you said that, despite of expensive valuations, earnings could be better in the mid cap and the small cap space. Thank you so much for giving us those insights and taking out the time and speaking with us at NDTV Profit.